it's my pleasure to introduce Ben. So he's our next keynote. He's unique in our keynotes that he's actually physically here. So it's really great to have you here, Ben. So thank you for making the time to come here. Ben is the MSA Charitable Trust Chair in Finance at Massey University. He is clearly one of the leading finance researchers in New Zealand, if not Australasia. He's published in the Review of Financial Studies, Management Science, Journal of Financial Markets, JBF, etc. And he's going to be talking about climate disasters and insider trading. Fantastic. So welcome, Ben, and over to you.
Okay, thanks very much, Ivan. And thank you for the invitation to come and present today. And thanks to Steph as well. It's been a very well-run conference, so good work there. So the paper that I'm presenting today is joint with 4 co-authors. So Mary is a former PhD student of mine, and she is now based in La Trobe in Melbourne. Third co-author and fifth co-author, Harvey and Nuttawat, are with me at Massey, and Nick is at AUT. So the topic of our paper is relatively simple, and the question, I guess, is quite a humble one as compared to some of the really important questions that have been asked and addressed in the papers I've seen so far. And the topic of the paper is the question of whether climate disasters, so things like hurricanes and floods, whether they influence insider trading. So we're thinking about how company insiders, being directors, being managers, and the like, respond to climate disasters. And they sometimes say that a picture is worth quite a few words. And this particular picture does sum up the main thrust of our paper. So we look at insider trading and the value of shares traded by insiders, and we make a very simple comparison. We look at shares traded by insiders in months where there is a climate disaster impacting a firm, and we compare that to the shares traded by insiders in other months where there is no climate disasters. And the numbers on the y-axis don't mean too much, they're in log form and so on. But what the red line or red arrow does indicate is a huge increase in insider trading in months when there are climate disasters. So of course, one graph doesn't make a paper. There's many robustness checks that are required to hopefully prove to you that the results are robust. Although right from the get-go, I would note that I think one benefit of this particular setting is I don't think we need to be so worried about endogeneity. It's a big concern in finance, isn't it? Our story is that climate disasters impact insider trading. I think it would take some fairly heroic assumptions to put forward the counter, being that insider trading is impacting the climate. So I hope you're okay with us ruling out reverse causality here. That's certainly what we've done. So the first thing we need to think about is, well, how do we define firms affected by insider trading? And we focus on firms that are located, that are headquartered in a county that is impacted by a climate disaster, and we look at that insider trading. So the result holds in general. If we look at all firms in the sample, we get a strong result. We do some cross-sectional analysis, however, and we notice that the result is weaker when insiders are faced with higher litigation risk, when they might be more concerned about repercussions from their insider trading. There is less climate insider trading. We find the result is stronger when investors are more distracted. So when other investors are more distracted by the climate disaster, it seems that insiders are even more likely to engage in insider trading. And then we find that the result is stronger in firms with more information asymmetry, so more opaque firms have a stronger relation. It's stronger in firms with low analyst coverage, low institutional ownership. So when there's less external monitoring of the firm, insiders are more prone to engage in this climate insider trading. And then we also find that climate insider trading is less prevalent in firms that score highly on ESG factors. So firms that are more focused on being better corporate citizens more generally tend to have less of this climate insider trading. So it's all very well documenting a result. It's more incumbent on researchers these days to also put forward an explanation as to why the result might be there. And in this particular context, we're thinking about, well, what motivates insiders to sell more of their shares, to buy more of their shares, to engage in more insider trading in climate disaster months? And we can think of at least two plausible explanations. I'll leave time at the end because there might be more, and I'd be keen to hear your thoughts on that. But the two that we think of, firstly, a profit motivation. So we suggest that it's possible that insiders are more or better placed to identify the impact of the climate disaster on the firm, and they can trade around that information more readily. Another possibility is that it's nothing to do with profit. It's simply a personal liquidity requirement. So the insider is living in the county impacted by the hurricane. The hurricane destroys the insider's house. They need to sell stock because they need to go and live somewhere else. So maybe it's as simple as that. Maybe it is a personal impact by the climate disaster story. We consider that as well. We rule in the first explanation. Our results support the profit motivation. They point against the personal liquidity explanation. In terms of the literature that we contribute to, we suggest that there's two sort of general strands, and the title probably gives this away, doesn't it? We think about climate and we think about insider trading. So we contribute to the literature looking at the impact of climate on financial markets. There's lots of great literature in this area that's been showcased at this conference. I highlight some published work in some of the more reputable finance journals. So we know that extreme temperatures impact earnings. We know that climate risks contribute to return predictability. We know that climate disasters have an impact on liquidity. And we also know that institutional investors are particularly concerned about climate risk. In terms of the insider trading literature, I just highlight two papers, two really nice papers in this space. The first one by Lauren Cohen and friends show that when we're talking about insider trading, we need to differentiate between routine insider trading and opportunistic insider trading. So many executives get remunerated by not only cash payments, but also by stock payments. So they receive part of their salary as stock. It seems reasonable, therefore, to expect them to sell that stock because they've got to pay the bills. So if you look at the insider trading sales, you tend to see quite regular patterns where often insiders sell once a quarter. And that's just realizing the value of their stock salary. What Cohen finds is that that's not particularly informative insider trading. It's the insider trading outside those windows, the opportunistic insider trading that seems to be more based on information. And then another paper in the JFE shows that some profitable insider trading, it's not actually based on insider information, it's based on publicly available information, but the insiders seem to be better placed to discern the impact of the information that's in the public, but the impact on the firm that they are close to. The data for this study, nothing innovative here. We just go to the Shelders database, which measures climate disasters from droughts through to wild weathers, winter weather. They also pick up geophysical disasters like avalanches and earthquakes, those disasters are in the minority, and we exclude them from the data set. We're just focusing on climate disasters. And then we pick up insider trading, which is defined as trading by insiders being officers, directors, and beneficial owners of more than 10% of a company's stock. So if we look at the climate disasters in our sample and look at them by county and consider the severity of them, I think this graph, this map will probably be consistent with your priors. It looks very similar to an equivalent graph that I saw a couple of presentations ago. Basically, you see the bulk of big disasters in Florida and in California. There's a few dotted around as well, but they're the two states that tend to be the most impacted by the disasters in our sample. So the first thing we do to start is just do some very basic univariate analysis, and we look at 3 insider trading metrics. We look at the trading value, the value of the shares traded, the volume of the shares traded, and the number of trades. And we ask the simple question, is there a difference between disaster months and non-disaster months? Remembering that a firm in our setting is said to be impacted by a disaster if it is located in a county that is impacted by the disaster. And we see strong statistical significance there and big economic significance as well. But of course, this is before we've controlled for a lot of factors, so we can't get too carried away with results at this point. So the next thing we do is set up a regression analysis whereby we specify climate disasters in 2 ways. The first being if there is a climate disaster for a firm in a month, we specify a climate dummy which equals 1, otherwise 0. We also measure climate impact based on climate damage, which is from Sheldis. It's the total dollar value impact of the climate disaster. We, as is needed these days, spend a lot of time thinking about different fixed effects, industry fixed effects, year-month fixed effects. That's quite an important one because, of course, a lot of climate disasters are quite seasonal. So the hurricane season plays a role here. If that just happened to coincide with a window around which insiders trade for other reasons, we could see spurious correlation there. So we control for that. County fixed effects, we cluster standard errors by firm and year. And this is just our baseline specification. I won't bore you with all the robustness that there is around this, where we specify alternative fixed effects and so on. And what you can see here is that there's a strong relation between climate disasters, climate damage, and insider trading. We add a lot of control variables into the mix as well. What I should have pointed out was the previous results were for firm level analysis. We also do the analysis at the county level, very strong results. Yeah, as mentioned, we include a lot of variables which is said to influence insider trading. So we include those in specifications as well. We try pretty hard to make the result go away, but it won't go away. So the result to us seems robust. I'm conscious of the fact that I'm standing between you all and lunch, so I'm sort of moving forward at pace. But I want to focus on some of the moderating effects here. So one of the things that we think could play a role here is litigation risk. There's been studies showing that litigation risk, the likelihood of firms being litigated for insider trading and the executives of those firms being liable for that is able to be measured to some extent. So we just use established proxies in the literature for litigation risk. And what we find is that this whole climate insider trading result is weaker in firms that experience higher litigation risk. So insiders are a bit less likely to engage in climate insider trading if they're worried about being sued for their insider trading. So that's the first sort of mitigating effect. We then think about investor distraction, because it seems quite plausible to us that if there's a hurricane raging through the county, that investors are less likely to be concerned about their stock portfolio and more concerned about whether their kids have made it home from school, more concerned about whether their house is just being destroyed. So the question therefore becomes one of, how do we measure investor distraction? How might we do that? And we're not at all innovative in this particular area. We just follow what's being done. So there's papers in the literature, and I think of one particular RFS paper, and they use Google search volume as a proxy for investor attention or an inverse investor distraction. And of course, you can't just use Google search volume based on company names, because if people are searching for Apple, it might be because they want to buy an Apple. It might have nothing to do with the company. If people are searching Amazon, they might want to go for a holiday. So the searching isn't based on company name, but it's based on stock ticker, because that's a bit more precise. Hey, if people are Googling AAPL, it probably means they're interested in the company rather than the Apple. So we look at Google search volume index data, and we look at abnormal Google search volume index data. And what we find is that when there's a climate disaster, there's less searching about stocks. Actually, I don't have the results, but we find there's more searching about climate-related keywords and less related searching about stocks. So we say that climate disasters prove to be a bit of a distraction for the general investor. And what we find here is that when that distraction is higher, insiders use that cover to trade more. So if the average investor is distracted, insiders will trade even more. Other moderating effects that I mentioned, so if information asymmetry is higher, if analyst coverage is lower, if institutional ownership is lower, and if ESG is higher, these are all factors that seem to influence the climate insider trading relation. So we come to our channel results. So the first thing we ask here is, if a firm is impacted by a climate disaster, does it actually affect the fundamentals of that firm going forward? Like, does a climate disaster actually impact the firm? And the answer to that is yes. We find that sales growth is lower in the periods ahead when there is a climate disaster. So this isn't a result that's original to us. There's an RFS paper that documents this. We just wanted to be sure that it held in our particular setting, and the answer is yes. The other thing we think about a little bit here is, well, insider trading, it could be insider sales, it could be insider purchases, couldn't it? We find it's pretty much insider sales in our sample. There's a lot more selling than buying going on. And I guess that reflects that typically the climate disaster is going to be worse news than what was hoped for. Therefore, there's more selling than buying. So what happens here? Well, we find that investors earn more profits than they normally would. This is insider investors earn more profits than they normally would from their sales. So by trading during climate disaster periods, they earn abnormal profits. That seems to be a motivation. So how do we measure this personal impact story? It's a challenge. Like, we don't have data that gives us the personal portfolios of insiders in the US. That just doesn't exist to our knowledge. So we have to get a bit creative here. And again, you might have a better suggestion for me on this. But what we do is look into the location of the insider, because we do know the physical address of each insider. So that means that we can split our sample into two, because some insiders are located in the same county as the firm and as the disaster. So some directors of the Dunedin-based company actually live in Dunedin. There's the climate disaster in Dunedin, their personal portfolios are impacted. However, the nice thing here is that a lot of directors actually live out of county. So a lot of directors are involved in a firm that's impacted by the climate disaster, but it seems reasonable to assume that none of their personal assets outside the firm are impacted by the climate disaster. So if there was a personal liquidity story here, we would expect there to be far more climate insider trading if the director was, or the manager was, also impacted by the climate disaster themselves, because that could be indicative of trading for personal liquidity reasons. You can see there's no significance, so we find no evidence of that. So we finish where we started. Our message is that insiders trade more in firms when the company is in a county experiencing a climate disaster. We suggest that the result holds in general, but it is stronger when, it is weaker rather when insiders face litigation risk. It's stronger when investors are more distracted. It's stronger when there is more information asymmetry, lower analyst coverage, lower institutional ownership, and less ESG in the firm. So why do insiders engage in this climate insider trading? Well, we suggest it's because they can make a bit more money by selling those shares at that time. It doesn't seem to be consistent with them selling because they need the money to rebuild their house that was just destroyed by the hurricane. So that is our paper. I welcome any questions or comments.
Thank you, Ben. Really great paper. Honestly, really enjoyed it. One question I have, and then maybe we'll take questions from the floor. Is there like a particular sector that's driving this? I'm thinking of, for instance, rates, real estate investment trusts, and stuff like that, right? I just wondered if you thought about that, looked at that.
We did control for like sector effects, but it is something that we can dig into in another way. It is fairly pervasive. So to the extent that REITs don't comprise a huge proportion of the US market, if it was sort of sector specific, it would be interesting that it's such a strong result when we're including all firms.
Yeah, I mean, I would be looking for a sector-specific result because I mean, I think there's more policy follow-on, right? And I wouldn't be surprised if it's maybe dominated by a couple of sectors in particular that are particularly exposed to these risks.
Yeah, it's a good point. Yeah.
So I just might help give you rather than just an empirical result, some sort of policy, like you know, SEC. You need to be looking at these guys in particular, right?
Yeah, it's a good idea. Thank you.
So I would Marinella. I think it's Marinella. Let's have a look. Yeah, Marinella Finta. I was wondering whether specific climate disasters have a stronger effect. I guess that's slightly related to my question. I would have thought some of these hurricanes and flooding might be driving the results.
Yeah, that's right. Like hurricanes do have a big impact. They don't happen so often, but when they do happen, they cause some major damage. So yes, like that positive relation between the dollar value of the climate disaster and the insider trading is indicative of some of those climate disasters that tend to wreak more havoc.
So you did look at this and you did find it in the results, right? Because again, in the climate finance literature, there's a lot of distinction between the chronic and the acute type risks. So it might be nice to classify them into those two and see where the effect is coming from.
And actually thinking about this, like we did follow some literature and only include climate disasters that had a dollar value impact of 50 million or more. So we're not including climate disasters that maybe cause 1 or 2 million of damage in a county. It is the bigger ones, but that most of them are still in our sample, even with that cutoff.
Oh yes, great, Sebastian.
You can take it away if you want. A couple of questions. The first one's just out of curiosity. How do you measure ESG when you control for it?
Yeah, I think that's just using the KLD MSCI metrics, just the overall metric. So it's not precision.
Yeah, it's just a control in this case. And then I was wondering if they're similar to some of the other questions in terms of breaking this down a little bit. Whether, because you showed that most of it's happening in Florida, California, and then some spread around. Is there a difference in how this is happening in Florida, California? Because they're quite different regulatory environments. Right?
Yeah, we hadn't thought of that, but it's a good point. Yeah, we'll look into that.
Versus other.
Yeah. 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 No, thank you. Yeah.
Yes, I was just wondering, because of the strong indicator when there's actually less disclosure, you know, whether it's for analysts or institutional investors or ESG, is one possible explanation that that information is not produced internally and therefore not seen as insider trading? So maybe linked to one of the other aspects that you mentioned, they look to their competitors or to their customers. That's the data. So by definition, they claim it's not insider trading.
Yeah, it's an interesting point, isn't it? I mean, I guess we follow the literature and say any time somebody that's within the company trades, it's insider trading. Okay, but that doesn't necessarily mean it's illegal insider trading. It doesn't necessarily mean that they are illegally trading on information that otherwise ordinarily should have been disclosed. So we're not claiming it's illegal, but the fact that they are the insider and the fact that they trade, we put those two together and say this is insider trading. Now, it is definitely more prevalent in firms that are more opaque, have less governance. So I guess these are all sorts of things that you should expect. And the result is borne out in that way. Yeah.
I mean, it might be a follow-on study, but it might be interesting to look at when these people actually trade, and then, you know, when these companies start to disclose stuff, right? Because if something's happened materially, they need to disclose by as soon as possible, right? I mean, do they? So it would be a totally different study, right? But the timing of these two things would be really interesting.
Yeah,
because, you know, it could be illegal or it could not be illegal, right? So it's the academic definition of insider trading rather than the legal one.
Yeah, and one of the things we do look at, because there have been changes, and you know more about it than I do, but changes in the US around insider trading disclosure. So it used to be that there was quite some window open to insiders to actually disclose their trades. That got reduced, and the publicity around insider trading is more discoverable in real time. You know, which insiders are trading, how much, and so on. So we wondered whether the result would completely go away post some of that legislative change, and it didn't. Like it still exists. So yeah.
Wonderful, Ben. I think we'll finish there, unless there's one final question. No, I think lunch is at the back. We're all pretty hungry. So it's been a long session, but it was a really strong way to end a long morning. So thank you very much, Ben. Fascinating paper. And thank you very much for coming along. Just to add, we will be coming back at 1:30, where we'll have Martina from Macquarie. And so those of you that are online, stretch your legs, have lunch. Not on us, unfortunately, but we'll be back in at 1:30. Thanks.